Introduction to gold versus bonds. Gold and bonds. Two assets that investors have long considered safe havens during uncertain times. While they are often grouped together under this label, they actually behave very differently depending on economic conditions. Understanding how each reacts to inflation, interest rates, and broader market changes is essential. The comparison between gold and bonds truly begins after 1971. This moment marks a major turning point in financial history. Before that, gold was directly tied to the US dollar, limiting its price movement. After 1971, both gold and bonds began operating in a free market environment, allowing for a more realistic comparison. It is also important to recognize the fundamental difference between the two. Bonds are debt instruments that generate income through interest payments, while gold does not produce any income. Its value comes from scarcity, trust, and its role as a store of value. This distinction plays a key role in how each performs over time. Why 1971 matters. The year 1971 marks the end of the US dollar's convertibility into gold. This shift created a fiat currency system, where money is no longer backed by a physical asset, but instead by trust in the government. As a result, gold became freely traded, and its price began to fluctuate based on market demand and supply. Similarly, bond markets became more dynamic, with interest rates reflecting real economic conditions. This transition allows us to analyze the true behavior of both assets. Without it, gold prices would have remained artificially controlled, making any comparison less meaningful. For investors, this period marks the beginning of exposure to modern financial forces such as inflation, central bank policies, and global economic events. Core idea of the article. The main idea of the article is to compare gold with 10-year government bonds. These bonds are widely used as a benchmark for long-term interest rates and provide valuable insight into market conditions. The analysis focuses on inflation and interest rates as these are the key drivers behind the performance of both assets. Rising inflation reduces purchasing power and can negatively impact bonds, while gold often acts as a hedge. Another goal is to understand how these insights can be applied to portfolio strategy. There is no single asset that always performs best. The key is recognizing the economic environment and adjusting accordingly. This presentation sets the foundation for understanding how gold and bonds behave across different time periods. Regime A, 1971-1980. The period from 1971 to 1980 was characterized by high inflation. One of the main causes was the oil shocks, which led to a sharp increase in energy prices and consequently overall price levels. During this time, real bond returns were often negative. Even though investors received interest payments, inflation eroded most or all of their gains. Gold, on the other hand, experienced a dramatic surge. Its price increased significantly as investors sought protection against the loss of purchasing power. Inflation and uncertainty created ideal conditions for gold to thrive. Impact on investors. For investors, this period was particularly challenging, especially for those heavily invested in bonds. Although bonds were considered safe, they were losing value in real terms. Gold proved to be an effective hedge. Investors who held gold were better able to preserve and, in many cases, increase their purchasing power. Inflation played a central role. When prices rise rapidly, assets that cannot keep up lose value. Gold, however, has historically served as protection in such environments. Key lesson. The key lesson from this period is the importance of real interest rates. When real rates are low or negative, gold becomes more attractive. At the same time, high inflation is harmful to bonds. Their fixed returns cannot keep pace with rising prices. Gold thrives in instability, uncertainty, and inflationary environments. This period clearly shows that looking only at nominal returns is not enough. Understanding real value and economic context is essential for making informed investment decisions. Regime B, 1981-2000. The period from 1981 to 2000 represents a complete shift compared to the previous decade. At the beginning of this era, interest rates reached extremely high levels, close to 15%. This was the result of aggressive monetary policy aimed at controlling the high inflation of the 1970s. After this peak, interest rates began a long-term decline that lasted nearly 2 decades. This created what is often referred to as a bond supercycle, during which bonds became one of the most attractive and reliable investment options. For investors, this was a highly favorable environment. They were able to lock in high interest rates while also benefiting from rising bond prices as yields declined. This combination provided both steady income and capital gains. Bond performance. Bonds performed exceptionally well during this period. High coupon payments provided strong and consistent income. At the same time, falling interest rates led to an increase in bond prices, generating additional returns. This rare combination of safety and profitability made bonds extremely attractive. As a result, they became a key component of many investment portfolios. Stable economic conditions and lower inflation also supported bond performance. Investors had greater confidence in the financial system, reducing the need for alternative safe assets like gold. Gold, however, struggled during this time. After its strong performance in the 1970s, its price stagnated or declined for many years. With high interest rates available elsewhere, investors shifted toward income-generating assets such as bonds. Since gold does not produce income, it became less appealing. This period highlights the importance of opportunity cost. When investors can earn attractive returns from relatively safe assets, gold tends to lose demand. It clearly shows how rising real returns can reduce the attractiveness of non-yielding assets like gold. Regime C, 2001-2011. The period from 2001 to 2011 was marked by major financial disruptions. It began with the dot-com crash and later included one of the most significant events in modern finance, the global financial crisis of 2008. Central banks responded by lowering interest rates and introducing unconventional policies such as quantitative easing. This involved increasing the money supply to stabilize the economy and support financial markets. These actions created an environment of uncertainty. When confidence in the financial system declines, investors tend to look for assets that can protect their wealth. Gold as hedge gold regained importance during this period. Rising uncertainty and concerns about systemic risk increased demand for safe haven assets. As a result, gold prices surged and reached new highs by around 2011. It served as protection not only against financial instability, but also against potential currency devaluation caused by aggressive monetary policies. In times of crisis, gold once again proved its role as a reliable hedge. Bond performance bonds remained stable and continued to provide safety, but their performance was weaker compared to gold. Lower interest rates supported bond prices, but also reduced future returns. Despite this, bonds still played an important role in portfolios by offering stability and liquidity. This period demonstrates that during times of extreme uncertainty, alternative safe assets like gold can outperform traditional ones such as bonds. Regime D, 2012-2019. The period from 2012 to 2019 was relatively calm compared to previous decades. After the global financial crisis, economies gradually stabilized, and central banks maintained low interest rates to support growth. Inflation remained low and predictable, creating a stable economic environment. There were no major global shocks that significantly disrupted financial markets, allowing investors to operate with more confidence and clarity. Such conditions are typically favorable for balanced portfolios where no single asset clearly dominates in performance. Performance comparison bonds delivered steady, although not exceptionally high, returns during this period. Low interest rates meant lower income, but bonds continued to fulfill their role as a stable and predictable investment. Gold, on the other hand, experienced a correction after its strong rise in the previous decade. Its price stabilized or declined slightly as the need for crisis protection diminished. Both assets performed reasonably well but without extreme gains. This was a period of balance where diversification played a key role in achieving stable returns. Investor environment. For investors, this was a favorable environment. Market volatility was lower and price movements were more predictable, allowing for better planning and long-term strategies. This type of environment encourages disciplined investing rather than speculative behavior. Investors focused more on steady growth rather than short-term gains. The key lesson from this period is that in stable conditions, no single asset stands out significantly. Success depends on maintaining a well-balanced and diversified portfolio. Regime E, 2020-2026. The period after 2020 has been defined by extraordinary events that significantly impacted the global economy. The pandemic caused a sudden halt in economic activity, leading to massive interventions by governments and central banks. At the same time, supply chain disruptions contributed to rising inflation. Geopolitical tensions further increased uncertainty in global markets. This period stands out as one of the most volatile in recent decades and presents major challenges for investors. Bond market impact. The bond market faced significant pressure during this time. At the start of the pandemic, interest rates dropped sharply, which supported bond prices. However, the situation quickly reversed. Rising inflation forced central banks to increase interest rates, leading to a sharp decline in bond prices. The year 2022 became one of the worst years for bonds in modern history. Volatility increased dramatically, surprising many investors who traditionally viewed bonds as stable assets. Gold performance gold once again demonstrated its strength. It reached new record highs, supported by uncertainty and geopolitical risks. Central banks also played a key role by increasing their gold reserves, which further supported prices. Gold continued to act as a hedge during times of crisis, reinforcing its importance in modern portfolios. This period clearly shows that traditional relationships between assets can change, and investors must remain flexible and adapt to evolving market conditions. Real interest rates and gold. The relationship between real interest rates and gold is one of the most important concepts in financial markets. Traditionally, gold is inversely correlated with real interest rates. This means that when real rates decrease, demand for gold tends to increase. The reason is simple. Gold does not generate income, so when real returns on safe assets are low or negative, the opportunity cost of holding gold becomes smaller. In such environments, investors are more willing to allocate capital to gold, which increases its demand and price. For many years, this relationship was considered a reliable rule in investing. Recent changes. In recent years, however, this relationship has started to change. Gold has continued to rise even during periods of relatively high real interest rates. This suggests that other factors are becoming more important. Investors are no longer relying solely on interest rates when making decisions. Geopolitical risks, global uncertainty, and increased demand from central banks have all contributed to this shift. This change highlights the evolving nature of financial markets and shows that traditional models may no longer fully explain asset behavior. Conclusion. The key takeaway is that real interest rates still matter, but they are no longer the only driver of gold prices. Geopolitics and broader economic uncertainty now play a significant role. For investors, this means adopting a more comprehensive approach and considering multiple factors when making decisions. Understanding these dynamics is essential for navigating modern financial markets. Long-term data insights. Long-term data provides valuable insight into how different assets behave over time. Gold has delivered strong returns, but with higher volatility. This means that while it can generate significant gains, it also comes with greater risk. Bonds, on the other hand, benefited for decades from falling interest rates, which supported stable and predictable returns. However, the year 2022 challenged the perception of bonds as completely safe assets, as investors experienced notable losses. Correlation patterns. Gold has an important characteristic. It is often uncorrelated with stock markets. This makes it valuable for diversification. It also tends to have a low correlation with real interest rates, although this relationship has shown changes in recent years. Recent deviations from traditional patterns indicate that markets are becoming more complex. Market evolution. Modern financial markets have evolved significantly. Central banks now play a larger role in driving demand for gold. As a result, traditional models that once worked well are no longer always reliable. Investors must adapt to this changing environment by considering a broader range of factors. Flexibility and awareness are now essential for successful investing. When bonds outperform, bonds perform best under specific economic conditions. One key scenario is when interest rates are high or declining. When rates fall, bond prices rise, generating capital gains. Bonds also perform well in stable, low-inflation environments. In such conditions, their fixed income maintains its real value. Another important factor is income from coupons. Bonds provide a steady stream of payments, which is especially attractive for investors seeking stability. When gold outperforms, gold performs best in very different conditions. It tends to outperform when real interest rates are low or negative. It also excels during periods of high inflation when investors seek to preserve purchasing power. In addition, gold becomes particularly valuable during systemic or geopolitical crises. In times of uncertainty, demand for gold typically increases. Strategic insight. The key strategic insight is that different economic regimes favor different assets. There is no permanent winner. This is why diversification is essential. Combining gold and bonds can reduce risk and improve portfolio stability. Understanding when each asset performs best allows investors to make more informed decisions. Portfolio strategy. Both gold and bonds play important roles in portfolio construction. Bonds provide income and liquidity, offering stability and predictable cash flow. Gold, on the other hand, acts as protection during periods of crisis. It often maintains or increases its value when other assets decline. Combining these two assets can significantly improve portfolio resilience across different market conditions. Modern considerations. In today's world, gold is increasingly influenced by geopolitical factors. Central bank actions, global conflicts, and economic uncertainty all impact its price. Bonds, meanwhile, are strongly affected by inflation expectations and monetary policy decisions. Financial markets are more dynamic than ever, requiring investors to continuously monitor conditions and adjust their strategies. Final takeaway. The final message is clear. No single asset consistently outperforms. Performance depends on the economic regime. Investors must understand the broader context rather than rely on one factor. A balanced portfolio that includes multiple asset types offers the best long-term stability. This balance helps reduce risk and prepares investors for unexpected changes in the market.